You are 65 years old, and you walk into the bank you have been a customer of for 30 years to begin your retirement process. Right after you, a coworker also walks into the same bank for retirement procedures. You are the same age, you both worked for decades, and you are both trying to protect the money you have left, but your coworker is given a numbered ticket and told to wait in the lobby. You, however, are escorted past the public desks into a quiet private room, where a banker already knows your name. Same bank, same retirement age, completely different treatment. Because when your working life ends, banks stop evaluating your future income and start looking at your existing wealth. Watch this video without skipping and see clearly how banks treat retirees at every financial level. From rejected loans to expensive transaction fees, from private rooms to high premium rates and even banks competing for your money. It is all in this video. If you always want to receive the right treatment in life, subscribe to our channel now and join us. Level 1. Barely retired at the first level. Retirement does not exactly feel like freedom. It feels like a small monthly payment that arrives just in time to keep life going. The retiree stands at the bank counter with a folded account statement in hand, watching the employee check an account with almost no cushion at all. There is income, but it is very thin. A basic retirement payment comes in, then quickly goes to rent, groceries, medicine, bills, and the next debt waiting at home. For the retiree, this money is survival. For the bank, it is limited cash flow. At this level, the bank does not see a future borrower with room to grow. It sees a customer with very little margin for error. One medical bill could push the account into the negative. One late payment could create a new fee. A simple emergency could turn into a credit problem. That is why the bank acts carefully, sometimes politely but rarely generously. Credit limits stay low. Loan offers are strict. Fees feel heavier because every dollar matters. And the hardest part is this. This retiree may have used the same bank for 30 years. They may have cashed paychecks there, paid a mortgage there, and raised a family while the bank watched their entire financial life unfold. But retirement changes the file. The old relationship becomes less important than the current numbers. The bank may still smile, but behind that smile, the system asks one question. If something goes wrong, can this person repay the debt? At level 1, the answer is definitely no, and when the answer is almost no, the bank keeps its distance from you. Do you think it is ethical for banks to act this way? Share your thoughts with us in the comments. Level 2. Dependent on a pension at level 2. The only difference between this retiree and level 1 is predictability. A regular retirement payment lands in the account every month. The bank sees the pattern. Same week, same amount, same source. This changes the treatment, but only slightly. Now the bank recognizes stability. It knows the income is coming. It knows the account is not completely random, but fixed income also creates a ceiling. Inside the branch, the retiree may sit across from a representative offering basic products, a simple savings account, a low-limit card, maybe a small loan with strict terms. The bank is willing to serve them, but it does not chase them. It does not build a strategy around them. It simply says, we know what comes in every month, and we know how little room is left. This level may look stable from the outside, but from the inside, it can feel tight. A car repair, a rent increase, or a family emergency can push the account close to zero. The bank notices this. It may approve certain products, but it prices them defensively. Interest rates may be higher. Credit limits may be modest. The retiree is no longer invisible, but not valuable enough to be protected either. Predictable, but not powerful. That is the second truth of retirement banking. Regular income creates a foundation, but it does not automatically create respect. Level 3. The debt-heavy retiree at level 3. Monthly income still comes in, but now it is surrounded by old financial burdens, credit card balances, medical bills, a car loan that lasted too long, a home equity line of credit used to survive difficult months. The retiree sits at a small kitchen table, sorting envelopes into piles, and every pile seems to have its own interest rate. For them, every bill has a story, a surgery, a family crisis, a necessary repair, a few hard months that somehow never fully ended. But the bank does not read the stories first. It reads the obligations. It compares monthly income against monthly payments. And suddenly the retiree looks more squeezed than they feel. Even if they have never missed a payment, the bank sees the pressure. A person with fixed income and rising debt becomes a file that must be approached carefully. Loan conversations slow down. Approval screens ask more questions. A simple request can turn into a long review. The retiree may hear phrases like ability to pay, collateral, and debt-to-income ratio. But beneath that language, the message is simple. The bank is asking whether this person's retirement income belongs to them or to their creditors. At this level, refinancing may come with strict conditions. A new card may come with a small limit. A personal loan may be rejected despite years of loyalty. The retiree does not feel poor. They feel trapped because every month money enters the account, but it has already been assigned to someone else. This is the third truth. In retirement, debt does not only reduce your money, it also reduces your banking power. And until that burden gets lighter, the bank keeps its distance. Level 4. The homeowner. With no cash flow at level 4, the retiree owns something real. A home? Maybe it is a modest house on a quiet street, with framed photos in the hallway and a mortgage that took decades to bring under control now behind them. On paper, this retiree looks stronger. The bank sees property value, equity, and an asset that can be measured, insured, borrowed against, and placed inside a financial file. But there is one problem. The home may be valuable, but the retiree's cash flow is still weak. This is where banks see a strange separation. They see wealth, but they do not see liquidity. They see collateral, but they do not see comfort. So the conversation changes. The banker may talk about home equity loans, refinancing, reverse mortgage options, or ways to access the value locked inside the property. The tone is more interested than before, but still cautious. Because owning a home does not automatically mean the retiree can handle another payment. At this level, the bank may show the retiree more respect, but that respect comes with conditions. The home gives the retiree negotiating power, but it also gives the bank something to protect itself with. This is the fourth truth. A valuable home can open doors, but if your cash flow is weak, the bank still controls the hallway. Level 5. The stable retiree. Level 5. The atmosphere changes. The retiree is not rich, but life has finally become organized. Bills are paid on time. The checking account does not fall to zero every month. There is a small emergency fund, a clean payment history, and a quiet sense that the next surprise will not destroy everything. The retiree walks into the bank not with fear, but with calm focus. The representative opens the account and sees stability, not luxury, not great wealth, but reliability. And in banking, reliability has value. At this level, the retiree may receive better treatment in small but meaningful ways. A fee may be waived. A credit card limit may be increased. A loan request may be reviewed more seriously. A banker may suggest a safer place to keep emergency money. The bank is not rolling out the red carpet, but it is no longer guarding every door either. This retiree has proven something important. Money does not need to be enormous to create respect. It needs to be under control. The difference between level 2 and level 5 is not always income. Sometimes it is discipline. Payments come in, bills are paid, debt is low, savings stay in place. The system begins to see the account as reliable because the account behaves predictably without constant stress. This is the fifth truth. In retirement, stability turns into a financial language, and when your money speaks that language clearly, banks listen differently. If you want banks to treat people according to ethics instead of levels, like this video right now and show your power. Level 6. The comfortable retiree at level 6. The retiree is no longer just surviving in retirement. They are living inside it with room to breathe. The mortgage may be paid off. Debt may be low or completely gone. There is an emergency fund large enough to handle real life. Monthly income covers expenses, and there is still money left over. The retiree walks into the bank with a different posture. Not arrogant, but unhurried. They do not need urgent approval. They do not need the banker to save them before Sunday, and banks can feel that difference. At this level, the bank begins to offer better terms because the retiree is no longer asking from a weak position. A secured loan may be easier, a credit limit may be higher, fees may disappear, Interest rates may improve. The retiree may receive calls about saving strategies, certificates of deposit, insurance products, or conservative investment options. For the first time, the bank's attitude shifts from defense to opportunity. It no longer only asks, "Can this person pay us back?" It also asks, "What else can we offer this person?" The retiree has not entered the elite world yet, but they have left the fragile world behind. They have options. If a product is weak, they can say no. This level matters. At lower levels, saying no is difficult because the retiree needs access. At level 6, saying no becomes realistic because the retiree has time, cash, and alternatives. This is the sixth truth. Banks treat you better when they sense that you do not desperately need them. Level 7. The invested retiree at. Level 7. The bank stops seeing only deposits and payments. It starts seeing assets under management. The retiree may have a retirement account, a brokerage portfolio, dividend income, bonds, index funds, rental income, or a carefully built mix of investments. A branch visit now feels different. Instead of only talking about bills, the conversation shifts to allocation, income planning, tax awareness, and risk. A banker may introduce an investment advisor who speaks calmly about charts, portfolio projections, and capital preservation. The retiree is no longer just someone receiving money. They are someone whose money can be managed, and this is one of the biggest changes in the system. Banks do not only profit when people borrow, they also profit when people hold assets, move assets, invest assets, and pay for advice around those assets. At level 7, the retiree becomes interesting because their money has depth. There are accounts to protect, investments to review, and future income to structure. The bank may offer planning meetings, lower fees, stronger tools, portfolio lending, retirement income strategies, and introductions to specialists. But receiving attention from a bank is not the same as receiving loyalty from a bank. Some offers may be useful. Others may be expensive products dressed in premium language. A retiree with investments must ask better questions. What are the fees? Who benefits from this product? Is this advice independent or is it tied to a sale? The bank's behavior improves at level 7, but the game becomes more sophisticated. This is the 7th truth. The moment banks see your assets, they stop only measuring your risk and start measuring your value. Level 8. The private banking retiree. At level 8, the retiree no longer waits for regular service. The bank separates them from the public system and invites them into private banking. The room is quieter, the chairs are better, and the banker is no longer just solving transactions. They are protecting a relationship. This retiree may have significant deposits, investments, real estate, income from the sale of a business, or assets accumulated over a lifetime. The bank sees a customer worth retaining. That is why the treatment changes. Private banker, premium cards, preferred rates, larger credit limits, investment management, faster approvals, better access to specialists. The bank now comes to them through calls, private meetings, and personal service. But private banking is not charity. It is competition. The bank is interested because the retiree has financial weight. Their assets can produce fees, deposits, loans, referrals, and long-term relationships. At level 8, the bank acts with urgency, not because the retiree needs help, but because it does not want them to leave. Level 9. The retiree planning an estate. At level 9, the question changes again. The bank no longer focuses only on the retiree's lifestyle. It begins to look at what happens after them. The conversation shifts to estate planning. Trust structures, beneficiaries, charitable giving, tax-aware transfers, family meetings, and wealth that may outlive more than one generation. The retiree sits in an elegant meeting room while advisors discuss not only accounts, but also the family structure. Who will receive what? Who will manage the assets? How can conflict be reduced? How can wealth be protected from mistakes, taxes, lawsuits, or poor planning? At this level, the bank wants to become part of the family's financial architecture. It does not only want to manage the money, it wants to manage the transition of the money. This can protect heirs and reduce chaos, but it can also feel strange, because the retiree may realize that the bank is already thinking beyond their life. The bank is no longer asking, "Can you pay?" It is asking, "Can we stay connected to your wealth after you are gone?" This is the 9th truth. At higher levels, banks do not only want your account, they want continuity. Level 10, family office level retirement. At level 10, the retiree no longer chases the bank. Banks chase them. Their wealth may include large portfolios, private investments, real estate, businesses, trust structures, family foundations, and multiple advisors already working around them. Now the conversation does not begin with a product. It begins with access. Which bank deserves to hold the liquidity? Which firm deserves to manage the investments? Which advisor deserves a seat at the table? At this level, the bank is no longer the center of power. It is one vendor inside a larger system. And this is the final transformation. At level 1, the retiree waits for approval. At level 5, they earn trust. At level 8, they receive premium treatment. But at level 10, they choose. They can compare banks, negotiate fees, reject weak offers, and move their capital if the service is not good enough. That is why the highest level of retirement is not being treated well by a bank. It is having enough control to decide which bank deserves. Retirement is not just the end of work. It is the moment when the financial system reveals what it thinks your value is. But the real goal is not to impress that system. The real goal is to build enough control that the system has to respect your choices. Because the more control you have over your money in retirement, the more control you have over how banks treat you. And once you understand that, the question is no longer, will the bank approve me? The question becomes, which bank has earned the right to serve me? This video was only one step on the path to financial success. If you want to walk this path with us and make the right decisions, subscribe to our channel and turn on notifications before you miss this opportunity.